Hello, my name is Lindsay Shuck. Thank you for joining today's Family Office Network's webinar series featuring Impact Venture Capital. I would like to take a brief minute to introduce our experienced speakers today. I will start off with Dr. Eric Ball. Eric is a technology finance professional who co-founded Impact Venture Capital, an early-stage technology venture firm. He spent 11 years working as Senior VP and Treasurer at Oracle, one of the world's premier technology companies. Eric has also served in various finance roles at Flextronics, Cisco Systems, Avery Denson's, and AT&T. Eric holds a PhD in management from the Drucker ITO schools, as well as degrees from the University of Rochester and the University of Michigan. Also with us today is Jack Crawford. Jack's early career as a PwC accountant exposed him to a range of businesses and inspired him to launch his own internet service provider. Jack founded 3 more software companies and was selected as Entrepreneur of the Year by the Money Hunt television show. Jack founded Velocity Venture Capital in 2005 and made several early-stage technology investments, including the first round in software machines recently acquired by Intel for $300 million. After collaborating with Eric Ball in 2012, Jack co-founded Impact Venture Capital in 2016. Jack also earned a degree in accounting from Arizona State University. At the end of today's presentation, we will have time for Q&A. We encourage you to submit your questions at any point using the questions chat option on your screen.
Great, thanks, Lindsay. This is Eric, and I'm very pleased to be here. Appreciate that kind introduction from Lindsay, and want to thank Lindsay, Audra, and the entire Family Office Network team. I also want to welcome those on the call from various family offices, some of whom already know us, and some of whom are hearing about us or from us for the first time. What Jack and I would like to do today is in a couple of parts. In the first part, we want to let you know how we think about venture as an asset class. And so this is less about us and our particular venture capital firm and more about, what the data shows us in terms of how venture as an asset class fits into a more broadly diversified portfolio, particularly with all of the volatility in markets across asset classes right now. So part 1 will be a discussion of venture in general. And I'll lead that discussion. Then I'm going to turn it over to Jack to talk about our particular venture capital firm, our thesis, our team, and our portfolio, and let you get to know us a little bit better and the particular investment thesis that we bring to deploying capital into early stage venture. And then we're going to leave plenty of time for Q&A because we'd really like to make this an interactive discussion as much as we can. We'd love to hear from you, and we'd love to address any questions that you might appreciate our perspective on. So with that, we're going to start with a look at the current markets across asset classes. As of last Friday, and it really isn't much different today, the S&P 500 was within 7% of its year-end level, but that masked a lot of activity, as you see on the chart here. At one point at the beginning of COVID, the S&P was down 34%. It's back to about down 7%, but that masks a lot of other dynamics that are going on in between. What it masks is that you have a handful of stocks that are doing well and a much larger number that are lagging. Over 3/4 of the stocks in the Wilshire 5000 are down year to date. So most people, unless they're invested solely in index funds, most people are doing far worse in their public equities than the S&P 500 index would indicate, because if you're a stock picker, the odds are 75% that you're down year to date. And another dynamic that's being masked is that the most expensive stocks on a multiple basis are going up, and the cheapest stocks are going down, and by a lot. The 50 most expensive stocks in the S&P 500 on December 31st are up 11% for the year. The 50 cheapest are down 17%, And what this illustrates is that investors are ignoring price completely and just seeking perceived safety throughout this COVID environment. But the real indicator of what's happening in public markets is that volatility remains significantly higher than a normal year. You see the VIX graph here showing that it's just blowing the scale of the chart out in terms of the level of volatility that we've seen just over the last couple of months. And some of you may have read in the Wall Street Journal last week about a whole new class of day traders called volatility traders, or as the Wall Street Journal put it, people trading for short-term kicks based on very few fundamentals. So, even though the public equity markets have partly recovered, they're still a volatile and not a calming place to be right now. International equity markets are faring even worse. If you look at the Vanguard, non-US stock market index, that was down 34%, now down 13% year to date, with just as much or more volatility than we're seeing in domestic markets. If you want to look at fixed income as an asset class, well, your yields are essentially zero. The 10-year Treasury yield as of a couple of days ago was 0.7%, or as I like to call it, reward-free risk in fixed income. And real estate has really fallen as well. If you just look at, I took the iShares U.S. Real Estate Exchange Traded Fund, and year to date it was down 37%. It's now down 12%. So, I basically the other asset classes that many of you are deploying capital to are sort of not looking uncorrelated. They're all looking bad at the same time, which is the opposite of what you try to achieve through diversification. In that context, we'd like to look at venture as an asset class, which remains, it has its ups, it has its downs, but it remains less correlated with these other asset classes than they are with each other. And so our thesis is that, if there's ever a time to increase the allocation of your portfolio, the percentage that you put into alternatives, and in particular to venture, that this might be a good time to consider doing that. So now I want to turn and look specifically at venture. And when we have most of the quarterly data that we have is pre-COVID, because COVID really flared up in mid-March, so there were only a couple of weeks left in Q1 when it flared up. So we don't yet see it in the quarterly numbers. But we have some indications. And before COVID, through Q1, venture investment had increased dramatically. And it's a multiple of the run rate that it was as recently as 2 to 3 years ago. So we see a lot more capital going into venture. When we look at early stage venture, we really see that venture is not one asset class, but two asset classes. It's late stage venture and early stage venture. And late stage venture has become a lot more like public markets, because it used to be that a company would go public as soon as it could, maybe if it hit 100 million in revenue. It's a relatively recent phenomenon in the last decade that companies have waited much longer to go public or even to be acquired. You cannot say that Facebook circa 2011 or Uber in 2018 or Palantir today are really the same asset class as three guys and a dog in a garage that have a brand new startup that you have not yet heard of. And what we're seeing in Q2 is that late stage valuations are seeing a larger impact because they behave more like public companies, and their valuations tend to be based on publicly traded peers. Early stage valuations are impacted, but less so. And so we're really seeing some different phenomena in the early stage venture as an asset class. One of the tough lessons of 2008 was that asset classes turned out to be more correlated than a lot of investors appreciated. And several that looked independent going up went down in lockstep. The US equities, international equities, fixed income, which is exactly what we've seen again in the current environment. But with early stage, there's a lag between the time that we invest in early stage venture and when we exit that investment. And that requires higher returns, but it introduces a useful shift in timing. which is that early stage venture tends to go up and down at different times than other asset classes. In addition to that imperfect correlation, we also see that early stage behaves better over the long run. And this is a really good graph showing the relative outperformance of early stage over various time horizons. And what we see is that over recent time horizons, it is slightly better than other asset classes. And over longer time horizons, it's dominantly better than other asset classes in terms of its independent risk return profile. A few other dynamics that from recent venture activity. I think it's understood that the amount of money going into venture has grown dramatically. In 2020, the baseline investment level in venture is about 5 times what it was in the last crisis, which was in 2008. I think what is often less well appreciated is the dramatic role that corporations have played in this growth in venture. 20 years ago, independent VCs used to refer to corporate venture arms as the dumb money. We do not see that now. Over the past few years, both the number and the proportion of venture-backed deals involving a corporate investor have increased dramatically. And Jack's going to talk about that later in terms of how that intersects with our own investment thesis. Before COVID, through the end of Q1, we saw sustained increases in investment activities in several of the core sectors that you're used to seeing over the last couple of years in venture. In artificial intelligence and machine learning, which reflects kind of the deep tech version of pushing the boundaries of AI, we've seen a market increase in activity in that sector. We also see growth in applied AI, which is the use of the tool to create efficiencies in other sectors. And that's helped stimulate growth in other sectors, particularly life sciences, software, and fintech. One thing that's interesting is, and not obvious in these charts, is that over the last year or two, the proportion of early stage dollars has decreased in favor of late stage deals. So a lot of the growth in these sectors, a lot of the capital that's flooding into these sectors, the dollars are coming into late stage deals, and these are the darling companies that are mature and getting ready to go public that you've heard of, you know, like Palantir, for instance, and that's coming at the expense of early stage, where there's less of the capital has flown in. A couple of other interesting trends. I used to be an academic, so I like to look at data. One element is the disproportionate share of venture financing that's received by founders who are young and male and predominantly white. There's data around a lot of those demographics. Recent data shows that women-led startups are growing in the financing they're receiving, but they're growing from such a small base that their share still remains small and not even close to proportionate with the fraction of women that act as entrepreneurs. They're receiving less than their proportional share. That's also true for older entrepreneurs, and it's true for non-Caucasian demographics. At Impact, we've examined the data to see if there's a relationship between gender or age and ultimate return on investment. And I just was a co-author on an analysis with some UC Berkeley faculty, which indicates there is no statistical relationship between gender or age and ROI for venture investors, which indicates that their underrepresentation by other independent VCs may represent a market inefficiency or an arbitrage opportunity for investors who are more open to different demographics in their investment approach. I want to end this broad look at venture as an asset class by comparing what's happening in the COVID crisis with what we've seen in prior crises. In 2008, 2009, we had the financial crisis. Late stage investing fell. Early stage investing only paused for a quarter and then actually increased. And if you look at the returns for the vintage years of 2008, 2009, you actually see that those were higher return years than 9 of the prior 10 years. So the last crisis turned out to be an unusually good time to invest in early stage venture. In this COVID environment, we're seeing lower caliber startups and lower caliber investors becoming less active. We're seeing some industries look less attractive in terms of activity and valuations, and that includes hospitality, energy, and automotive. And you're seeing some industries really get a tailwind out of COVID, including digital health, remote tools, automation, and cybersecurity. And that's useful to keep in mind as we later talk about how we take this data and use it to inform our own particular approach to venture. So with that, I want to turn it over to my partner, Jack, to tell you a little bit about us and turn this from a broad discussion of venture into the particular way that we approach investing in early stage startups. Jack, please take it from here.
Great, thanks, Eric. Well, I'm excited to be here and basically experience share on some things that we're doing in the venture capital asset class that that may be useful to you as you explore direct tech investing or co-investing alongside of venture funds or even investing into venture funds directly. And so the spirit of my comments will be a bit of experience sharing on some of the things that we're doing that we see working in line with some market trends. So next slide, Eric. Great. So just a little bit of an overview on sort of how our strategy came together. Eric and I collaborated in managing the private equity and venture portfolio at Oracle. We had some great success at actually finding pathways to exit for some of the ownership positions that Oracle inherited after significant acquisitions of Sun Microsystems, BEA, and PeopleSoft. Those underlying companies made direct investments into early stage technology companies, and when Oracle acquired those three companies, they inherited a large venture portfolio that Eric and I had success managing out. We realized along the way that corporates effectively were starting to play a larger and larger role in the venture ecosystem, and they were sort of shifting from participation in venture deals, sort of participating in 1 out of every 10 venture deals just a few years ago to now today participating in 1 out of every 3. In 2019, 1,400 corporate venture groups invested into a seed and early stage venture startup company, and we think that's interesting. And we think the more we learn about where these corporate venture groups are investing and where they're acquiring companies, the more it may elevate our investing IQ. So with that thesis, we received $25 million worth of institutional backing from corporates, from university endowments, from foundations, and we went to work to prove out this thesis. We invested in 15 companies. Since inception, 8 have had upticks in value because of co-investments in the companies that we initially seeded by Intel and Baidu and Yamaha and SK Hynix and Goldman Sachs and a number of others. And so our strategy of identifying interesting innovations, investing in them, and then co-investing alongside of corporates enabled us to receive a number of upticks in value in the portfolio as they paid higher prices. And now our companies are beginning to be acquired. So recently, Thomson Reuters came in and acquired one of our companies for $125 million. That was just 6 weeks ago. So it was, right in the middle of COVID. And so what we're finding is our activities, our business activities didn't slow down. The companies that we invested in seem to be able to navigate through even turbulent times. So now we're out building our next fund. It'll be a $50 million fund 2. Of course, our existing LPs rolled into our fund 2 with follow-on commitments, and so we're excited about sort of the next step in our growth. Go ahead and go to the next slide, Eric. So just a little bit more information on how we are engaging with the rise of corporate venture. So clearly, as the corporate venture firms play a larger role in the venture ecosystem, if we can figure out a way to broadly contact many of them and then sort of deeply engage with them, we feel like we'll have a greater understanding and be enlightened as to key industry trends and how to work with some of these companies. So we've run large-scale events. We've leveraged the fact that Eric and I went through the Kaufman Leadership Program, a training program for venture capitalists that you may be familiar with. We've co-invested, as I mentioned, alongside a number of these corporates, and now we're lining them up to acquire some of our portfolio companies, and that's how we expect to generate outsized returns. Next slide. So in looking at where these corporates are investing and where they're acquiring companies, we found something interesting, a massive trend around artificial intelligence companies. And so why is that? You know, what's the deal with AI? Well, if you remember the early days of the internet, I think it was viewed as sort of an interesting technology that was quarantined to sort of, you know, deep tech. And now we recognize that internet technologies apply everywhere, whether you're talking about retail and e-commerce or whether you're talking about you know, data storage in the cloud. You look at every major business segment, every major consumer segment, and of course the internet applies there. That's what's happening right now with artificial intelligence. And so you see AI being applied to agriculture, you see AI being applied to security, to retail. We have some specific examples of companies that we found in those spaces that we think are interesting. In addition to investments in those spaces, artificial intelligence companies are now being acquired at an accelerated rate. And so when we look at investing in young companies, obviously, if we can develop a roadmap to how they're going to be acquired in the future, we increase the likelihood of that happening. And so again, the more that we understand about the co-investment and acquisition habits, priorities, trends of these corporate venture groups, the better positioned we are as an early stage investor, and you might be too, the more that you learn about those corporate venture groups. Next slide. So programmatically, our strategy, and this may be something that's instructional for many of you that you'd mirror and look to do in a variety of ways. We looked at outreach to corporate venture groups just by making phone calls initially, interviewing them, understanding. And then we recognized that the entrepreneurs that we're interacting with wanted that information as well. So we launched something called Impact TV, and it's now shifting from monthly to weekly, where we interview the head of a corporate venture group and get enlightened on, in a sense, where they might be investing. So 18 months ago, I interviewed the head of Yamaha, and I know them as a motorcycle and piano company, a piano manufacturer, and they said they were interested in automation in the agriculture space. They said that the workforce development was going to change, the workforce in California was going to change, and that they thought farmers might be looking for ways to automate some of the things that are happening in the fields. We invested in a company called Advanced Farm. It's a robotics company that picks strawberries using video technology, a robotic arm, air compressor, and some sensors. We participated in the early round of that company, and Yamaha, sure enough, came in and led the next round of financing at a significant uptick. And so we sort of feel like we got visibility into an area that they were interested in. Sure enough, they came in and co-invested with us in a subsequent round at an uptick. We're also doing things like monthly deal flow calls. So we connect with Samsung and Micron and SK Hynix and others about their hunt list, if you will, the types of companies that they're looking for, the industry sectors that they're focused on, their most promising deals. So we do a monthly call with them to just sort of share deal flow, and that's resulted in some real benefit for our firm. We have internal research capabilities, and then we distribute out a newsletter to corporate venture groups and other investors to let them know about our activities, some of our point of views on key investment trends and thesis and hypothesis and other elements of our investment thesis. We host, as I mentioned, these events that programmatically bring together market innovating startups with market leading corporations. And we try and act as the thought leader or the bridge between those two groups. So for the last 3 years, we've hosted something called the Impact Global Venture Summit. It's an event that attracts more than 1,100 participants, mostly corporate venture groups, startups, and others that are deeply involved in the technology ecosystem. So you can see we're going broad and deep, and I think that's instructional for family offices in particular, because the more insight you can get to where these corporates are investing and acquiring companies, I think the better you're going to do with your portfolio. And I'd also say that there's probably a lot to learn from other venture funds, sharing information, experience sharing with other venture funds on what you're doing and what's working, and that's the spirit of some of our comments today. Next slide. So just a snapshot on how we built our team. I know many family offices are looking at building out internal venture capability. Some are investing into funds and then investing alongside of those funds to average down their fees and carry. And when they do that, they look at sort of, building out their internal venture capability. And so as an example, we have there's a successful family office in Southern California called Mark IV. They've been quite successful at both investing into funds and then co-investing alongside of those. And so as we looked at building our venture capability, what we try to do is balance sort of finance expertise and startup expertise. And Eric had extraordinary success at Oracle, managing $50 billion, reporting to Larry Ellison, effectively participating in Oracle's 105 acquisitions along the way. Teaches you a lot about how corporates are thinking about acquisitions. I had a great deal of fun collaborating with Eric through the Kauffman Fellows program. We developed a friendship there. And then when Oracle needed help with managing out their venture portfolio, we got together and effectively had some success in managing that portfolio out. So we've got some team history, and our skill sets complement each other quite well. I also had some early success, a seed investment into Soft Machines that was acquired by Intel, and then I was the early mentor for Pondera, the company that we've talked about that recently got acquired for $125 million by Thomson Reuters. Next slide. So we realized as artificial intelligence is applied to a variety of sectors, in addition to a very capable operating team, we also wanted to build out a team of venture partners. And so this is a group with very diverse backgrounds by industry sector, who are experts in cloud computing. They're experts in cybersecurity and ag, in media tech. And so what we're able to do is, as we're looking at the market, the technology, the team, the customer base, the financial model of an individual company, Eric and I can go out to these venture partners and effectively engage them in their area of expertise to collaborate with us on the review process. Many family offices that I know have broad networks of relationships, and if they were to organize sort of their network in a similar way, where you have your industry expert in each of the key areas that you want to focus on, it might be an interesting way to think about the due diligence that you do on individual companies. Next slide. So now this is where things get fun. This is our actual portfolio, and I thought this would be instructional as it related to investments that we've made and why. I can't highlight all of these, although I would love to. I only have a small allocation of time here. But AWM Smart Shelf is listed under retail. It is a cashierless shopping experience using video cameras, using sensors on shelves, and an app to allow a customer to go into a small convenience store and effectively pull things off the shelves, put them in a bag, and check out without ever interacting with a cashier. You can imagine over the last 3-4 months how this particular technology has skyrocketed. This is AI applied to retail because there's facial recognition involved, and there's other pattern recognition involved. And so AI, as the world got globally connected, effectively as massive amounts of content get uploaded, there's opportunities for pattern recognition in retail and all of these other areas. And interestingly, AWM Smart Shelf just received a $10 million commitment from an Italian-based corporation. So it was an opportunity again for us to co-invest alongside of a corporate into a company that's got some real traction. Pondera, we talked about, it was a company in the fraud, waste, and abuse area for government programs. They identified successful sort of pattern recognition techniques that were applied to helping to discover various things in government programs, and that was very valuable to Thomson Reuters as they were looking to penetrate the government segment. So that was an interesting and successful investment that we had. TaskHuman is a company that is focused on the health and wellness space, using a video platform to enable one-on-one coaching, whether it's stress management or yoga or meal preparation or nutrition. Corporations are looking, particularly given this new normal of everybody working from home, to extend out health and wellness benefits to their employees. So the corporations are allocating sort of a certain stipend each month for employees to use this service, and TaskHuman is providing a network of coaches in a variety of areas that allow employees to effectively access these health and wellness benefits remotely. Maybe just two more that I'll mention. When I get excited about our portfolio, I get going. Infinitec is an omnidirectional treadmill that was showcased in Ready Player One. It has a combination of a treadmill that can walk in any direction with VR that is being used for military training, physical therapy, gaming, and at some point it will be used in the fitness space. The initial unit was purchased by Palmer Luckey. You may know Palmer. He sold Oculus Rift for $2 billion to Facebook. So he's an informal advisor for the company. Last one I'll mention is Scava. Scava is a headphones company that monitors, in a sense, the brain's engagement with the content that it's listening to. And we think this is a really interesting company. And it's another example of sort of AI applied to a market segment like media and entertainment. Well, I wish I had more time to tell you about the rest of our portfolio companies, but you've heard everything from robotics that pick strawberries to headphones that monitor brainwaves and everything in between. And that's why we're so excited about our portfolio and these innovations, their impact on the world, and the extraordinary opportunity for returns. Just one next level of granularity on Pondera. We mentored this company early on, helped them with their business plan. They grew, they got some traction, they started getting some revenues. They closed on a $20 million round. We ended up co-investing alongside of Sarant Capital, a successful private equity firm. They grew their revenues a bit more, and then they were ultimately acquired by Thomson Reuters. This is the recipe for success for us that I think you can mirror, and that we'd love to collaborate with family offices on, sort of, figure out a way to mentor these companies in the early stage, provide them with a little bit of capital, give them visibility to where corporates are investing and acquiring companies, help them assemble that next round of financing so they can really scale and grow, and just watch their valuation go up all along the way until they achieve that liquidity event. So great success with Pondera, and more to come with our portfolio. The last one I'll mention is Kornami, and Kornami is a really interesting high performance computing company that has identified a way to coordinate fractional cores within a computer. They're in a very hot space. If you've watched this space at all, the AI chip space, what's happening is there's acquisitions in the $500 million to $2.5 billion space. We have about 11% ownership interest in this company, so it's a very significant holding for us. There's an area of security called fully homomorphic encryption, and this is an area where effectively the world has concluded that the data center can only provide so much security. And so now they're looking at strategies for protecting the data, and that's what Kornami has been able to figure out. They have more than 70 patents that have been issued now around their technology. So it's a significant technology differentiation protected. I sourced this company following a successful co-investment with Gordy Campbell. Gordy was at Intel for a while, and then did some venture investing, and then started getting more deeply involved in operating roles at companies. He's produced about $4 billion worth of exits during his entrepreneurial career, and then started actively investing. I met Gordy when we co-invested in Soft Machines, the company that was mentioned earlier that was acquired by Intel. And so we're quite excited about this company. We've recently added Jan Geldmacher, the president of Sprint, to the board of directors. They brought in Dr. Wally Rines as the new CEO as the company starts to scale up. So this has just been a great collaboration with the Kornami team, and we're excited about the potential of the company going forward. Eric, I'll turn it back to you, and maybe you could highlight some of the companies that we've identified for Fund 2, and so I'll turn it back to you, Eric.
Great, thanks, Jack. So I want to touch on Fund 2. Some of the companies we've talked about have been from our successful Fund 1, and that fund is closed. Fund 2 is our current fund. We are raising for that fund, and we did an initial close around year end and started deploying capital into Fund 2 companies already. And I want to touch on the first 3 investments that we've made out of Fund 2. The first one in January was a digital health company called Syntegra. Syntegra is a spin out of the UC San Francisco Medical Center. They had an innovation center led by a cardiologist named Michael Lesh, who got so excited about one of their initiatives that he spun out of UCSF to form this company, which is applying new techniques in machine learning to create synthetic medical records to improve health outcomes. And this is a very big business. There have been real issues in using personal medical histories to improve research, drug development, and health outcomes because of concerns around privacy and HIPAA. And so people could not share medical records. The first solution was to just strip out name and address and try to share medical records. But it turns out that that does not sufficiently de-anonymize, or rather anonymize medical records, because they can be de-anonymized. What this company does is they create synthetic medical records with machine learning in a way that completely preserves privacy, but lets researchers benefit from knowing the health outcomes of various people in the system, in the records of a healthcare system. And we made this investment in January. If we had been trying to invest in a COVID-friendly business 2 months before that became a well-known thing, we couldn't have made a better choice. Their very first customer is the Gates Foundation, which is using this technology as part of leading the charge in fighting COVID. So Syntegra is having to grow up in a hurry because they're getting a lot of attention right now. And they're still completing their initial seed round that we were a part of earlier this year. So that's Syntegra. That was our first Fund 2 investment. Our second Fund 2 investment is a predictive analytics company called ScoreData, which also leverages artificial intelligence to really drive forecasting, prediction, and efficiency in agent-intermediated businesses. This has implications for supply chain management and throughout, in terms of helping businesses become more efficient, lowering their overall costs, and streamlining their operations. They're currently raising a $4 million Series A, and we remain enthusiastic about ScoreData. And the last company I'll mention is a company called CapConnect. We invested in them yesterday, and CapConnect was an example where we stepped beyond the process of reacting to CEOs who come to us and ask us for money. We were actually in on the birth of this company by saying what companies in a space should exist but don't yet. And so we helped form this company, recruit the CEO, and serve as its first investor. And CapConnect really is a disintermediation play, which allows corporates that issue bonds to bypass bank underwriting teams, debt capital markets desks at banks, and connect directly to the institutional buyers of those corporate bonds. So this is a great example of using technology to disintermediate functions that used to draw a lot of economic rent from simply serving a matchmaking function. And we think that that's a common theme for investments now, both AI and other investments now. And this represents a capital market subset of fintech, and one that I have some experience with from the corporate bonds that I issued in my prior career at Oracle. So we think CapConnect is a capital efficient model that has really a stupendous potential. The last point that I think Jack and I want to make before we turn this over to you for your questions is around the co-investment opportunities that we offer. We view our role, once we invest in a company, our role is to help that company succeed. Part of helping that company succeed is playing an active role in filling out investment syndicates for each round. And we come to our partners, we come first to our own LP investors, and after that, we come to other people in our network and allow them the opportunity to co-invest with us and essentially double down on those companies that they find particularly compelling, or perhaps they can add value to. In our Fund 1, we have current opportunities for investment in Adroit, which is the cashierless shopping, which is getting a huge tailwind from retailers' desire to not have cashiers interacting with customers. It lets people walk in, grab something off the shelf, and walk out and be charged in the same way that you're charged in an Uber without ever taking out your wallet. TaskHuman uses AI digital coaching to enhance at-home health and wellness. A lot of corporates are interested in tele-wellness programs, particularly in the age of COVID. They're raising around and they're seeing a lot of traction in this environment as well. Cornami is a company that Jack already covered that's really a high-performance computing company with use cases across a variety of applications. And then there are the three companies that I've mentioned in Fund 2, all of which are raising money now, and all of which we offer our own partners and LPs access to as part of what we do, both for the companies that we support and for the family office and other investors that we support as well. So, you know, we've got 16 minutes left in the hour. I would like to hear from you. I invite people to submit questions on the site. We have several questions which have already been submitted. And so while we invite additional submissions, I'm going to parse out some of these questions for me and some of these questions for Jack, and we really appreciate those of you who've already submitted. The first question is the easiest. June Choi asked, can I get this deck? And the answer is clearly yes. You can get it from the Family Office Network. You can get it directly from us. Our email addresses are very easy. It's eric@impactvc.com and jack@impactvc.com. And we are delighted to send you the overview that you just saw. We have I think the next question that we'll take comes from John Samuelson at Karis Partners. And I'm going to ask Jack to field this one. And John Samuelson's question is, what is our process for picking, vetting, and onboarding our target portfolio companies?
Sure, I'll just comment briefly. So a big part of our strategy has been to develop out deal flow sources, right? Where are we going to see these investment opportunities by geography, by industry sector, by sort of market segment? Our venture partners have been very helpful. Obviously, our corporate venture network of relationships has been very helpful. Eric and I have broad networks of relationships that throughout the industry after, you know, operating in tech for you know, 2 decades each, and so those relationships produce but around 3,000 to 4,000 investment opportunities for us to look at each year. And then we sort of look at 5 or 6 key areas. We look at the market. Is it a $1 billion market opportunity? We look at the technology. Do they have intellectual property or visibility to an IP portfolio? We look at what customer traction do they have. We look at how experienced is the management team. Have they been involved with venture-backed deals? Have they had successful exits before? And then we look at sort of finance and fundraising. And if all of that aligns with our strategy around sort of artificial intelligence applied and co-investing alongside of corporate venture groups, then we feel like we've sourced some high caliber deals and we've vetted them in a significant degree. And then we negotiate with the entrepreneur on ownership. And so we're trying to really zero in on where we can maximize our ownership level, because it's such a big component of the ability to generate returns. Where I see family offices running into challenges is they source some interesting deals, but they don't recognize all the other companies that are out there. So the caliber of deal flow that they have is a bit lower. They don't do this professionally for a living, so they don't have all of the resources or experience required to do all of the due diligence at the depth that a professional venture fund does. And then on the portfolio management side, they have difficulty getting information from the companies. They're playing more of a passive role as opposed to an active role. And so from a portfolio management standpoint, they sometimes run into challenges in securing the next round of financing or really understanding what's going on with the company. We try and help with that. We view ourselves as a valuable partner for family offices.
That's great. Thanks, Jack. Another question that comes in from Pat Bumpus is, how are we adjusting to doing diligence in a virtual age, and how are we seeing family offices who directly invest adjusting to the COVID age in terms of diligence? And I will offer a couple of remarks, and this actually intersects with a broader question we've gotten about how COVID has impacted investment. So let me take the first element of that question and invite Jack to take the second element of that question. In terms of how we in family offices are adjusting to diligence with less in-person contact, I'd say that we're relying heavily on remote tools and teleconferencing. We have we have a backlog of good investment opportunities, which means that some of the companies that we're diligencing now, we have spent a lot of time with in the past. Others we are getting to know remotely, but we take a very broad role in diligence. We engage with the team. We engage with prior coworkers and investors from any companies that the entrepreneurs were associated with in the past. We engage with the customers. We have the engineers from the startup speak to the engineers on our venture partner team. And we are very thorough at leveraging both the in-person experience that we have and the teleconferencing tools. And one of the dynamics that we're seeing among the family offices that are already LP investors with us is that they're relying more heavily on us to outsource elements of their own due diligence. Some family offices are finding it a little bit more challenging to really get to know a startup company well enough to write a check. And I think that what they're doing is they're using their fund investment in us as a form of outsourcing both deal flow and diligence in a way that lets us leverage our own strength in diligence in a COVID environment. Let me turn it over to Jack to answer a different question that's come in, but it's a broader version of the same question, which is how has COVID impacted both the investments that we make and how we make them?
Yeah, let me just comment and say that we had to go through our existing portfolio, 15 companies during this time. One got acquired. So that was a great news for our LPs and for us. 14 left. We went through and said, which of these are facing some real challenges given sort of the COVID crisis? And I'd say about a third were facing some significant challenges. They couldn't deploy their technology to customers because they couldn't travel. And there are other dynamics. I'd say about a third of the portfolio was facing those types of challenges. We did a couple of I think, smart things. First, we had a real heart-to-heart conversation with them about cutting expenses to extend the cash runway through the end of this calendar year. It was just about weathering 2020. Just do what you can. Eric and a couple of other people on our team became experts in the PPP program, and so we were able to support our portfolio. And I think it was I think it was 13 out of 14 secured PPP funding. So now some resources effectively with the government programs and a reduction of expenses. That third of the portfolio is well positioned for 2020 now. The other 2/3, it was really interesting to see an uptick in interest because of the virtual nature that we're all operating in. So whether you're providing sort of one-on-one video coaching, or we have a company that's focused on a HIPAA compliant platform that connects doctors and patients. Well, how often are doctors and patients looking to connect remotely these days? Farmers were concerned that if one member of their workforce got COVID-19, that the entire workforce would get COVID-19. So they started looking into automation opportunities like robotics in the fields. So what we're seeing is the other 2/3 of the portfolio company is actually scaling up their access to customers, revenues, and that's enlightened us on the types of companies that we should be looking for going forward. If we are all entering into a new normal, how is higher education going to change? How is retail going to change? How is security going to change? We're going through segment by segment and saying, sort of how are these changes going to impact where innovation is required? And we're collaborating with corporates along the way. So I feel like we're learning through a fire hose, and we're going to end up making some pretty smart decisions going forward.
Great, thanks, thanks, Jack. One question that comes from Glenn Kindred at Dimitri Global is, how do we consider liquidity options in our investment decision? And let me address that. Liquidity tends to come from IPO or acquisition. As an early stage fund, we sometimes get exits quickly. We were fortunate to have the acquisition of Pondera in March in the middle of the COVID crisis. But sometimes our successful companies take longer to exit. When we think about liquidity, we think about the return, and return is a function of two things, both the multiple that we can achieve and the time. So there's always a trade-off between how big can this get and how fast can it get there. And that informs how we ultimately make investment decisions. But really what drives it is the power law, which is dominant in venture returns. And the power law says that in a large portfolio, for most venture capitalists, the majority of returns are going to be in one or two of the companies within a large portfolio. Peter Thiel explains this in his book 0 to 1 very effectively, where he talks about how Facebook returned more than all other investments in his portfolio combined, and excluding Facebook, Palantir returned more than all everything else besides Facebook combined, and that everything else was almost a rounding error. So because of that, we really want to ask how big can this get? Some entrepreneurs are trying to tell us how they're going to avoid a bad outcome. That's important, but we really want to know if everything goes well, how big can it get? How can you manage growth? And the data suggests that returns are driven by modest probabilities of extreme outcomes more than by higher probabilities of merely decent outcomes. And that really informs how we think about liquidity. Is we look for companies that have not just a good shot at hitting a single or a double, but a reasonable shot of hitting a home run. And ultimately that liquidity is going to come rarely from IPO, most often from acquisition. And that's why having the relationships with the corporates that are the acquirers in a particular space from early on, we think really tilts the probability weighting on the returns more in our favor. So that's how we think about liquidity options to address Glenn's question. Fifth question is a little bit, I think, shorter, and that is, what is our minimum investment? Jack?
Yeah, so for family offices, we've established a minimum of $1 million LP commitment. It's drawn down over a 5-year period. 20% capital calls each year is our target. For institutions, corporations, for larger university endowments, foundations, $5 million is the minimum.
Great, thanks. I have a question that is, how do we initiate relationships with family offices that don't really have a VC expert or VC fund history? And the answer is we collaborate with our family office partners on your terms, and we have some family office LPs who have a long history of direct and indirect investment, both themselves and through funds. And we have others that are newer to the space, and we will engage, to the extent that we can educate. We're happy to do that, and so we just invite you to reach out to us and tell us how we can be most useful to you in meeting your goals for diversification with venture as an asset class.
The only thing I'd add is on that is family offices seem to be deploying a strategy across the country of looking at ways to make LP commitments into venture funds that they think will lead to a productive collaboration, and then co-investing alongside of those venture funds into the deals that they're most excited about. And so this is a way for them to increase their ownership interest in a higher caliber of investment opportunity than they typically get exposure to. So envision we have a number of family offices that made a commitment to our fund and then are actively co-investing alongside into those deals that they find most interesting. And that allows them to average down the fees and carry for their allocation to the venture asset class. That structure seems to be pretty common and growing, I think, as a pattern.
A question from John Bova is, to whom do we direct the conversation of our thesis to within a fund? And I'll just say it's whoever the fund identifies as the most appropriate person. And it's okay if that person doesn't have a lot of prior history with venture. As the GP, it's incumbent on us to come to the family office on its own terms. And we're happy to talk to both people with deep and extensive experience in venture and those without. So we let the family office determine who we engage with there. We just had a question come in that's interesting. I'm not sure I have a very informed answer. And it talks about the Department of Labor is saying that 401ks will be soon able to invest in private equity and venture. And do we see 401ks as a viable platform, or potentially having too many hazards so far? I will say that I think it will eventually be a viable platform. I'm not sure it's there yet. It really, I think, moves people. I think when it moves in that direction, it will be more with funds than with direct investment. Because I think that a fund structure lends itself more to compliance and other elements of existing within a 401k. But I think it's a little bit early to know for sure how that's going to play out. And so I don't want to overstate my own estimates. I think it is an interesting development, and one that bears looking at by both family offices and by us. And Jack, I'd ask if you have anything you'd add to that.
Yeah, as individuals have greater level of control over directing their own retirement assets, clearly you do not want to take sort of a significant portion. You're not going to put 25 or 50% into venture capital or alternatives. I think what you want to do is look at the asset allocation strategy of groups like the University of San Francisco's endowment. It's one of the top performing university endowments in the country as it relates to private equity and venture. They happen to be one of our LPs in Fund 1 and Fund 2. We've got some incredibly smart people there. And if you look at their allocation to alternatives, it's about 15%. And so as you go through and sort of look at any kind of self-directed investment opportunities with your own retirement assets, I think you want to look at somewhere between 5 and 15% into alternatives. And if there's strategic value, meaning that as a family office, if you can get greater access to deal flow, if you can get some internal training on how the venture capital asset works, how venture funds work, and get a greater access to technical resources for due diligence, then maybe there's some strategic value for some of the co-investing you're doing.
Thanks, Jack. Well, I see we've reached the top of the hour, so I think we'll stop taking questions here. I want to leave you with two things. First, please follow up with us, Eric at impactvc.com, Jack at impactvc.com. We would love to have a one-on-one conversation with each of you. I will also tell you, I hope I'm not stealing Lindsay's thunder by telling you that there will be a recording of this webinar available through the Family Office Network. If you missed any part of it and you'd like to view it, I believe that option will be available.
Thank you so much, Eric and Jack, and thank you to everyone who attended today on behalf of all of us at Family Office Networks. As Eric mentioned, we will be following up with all of you individually if there's any further questions. We welcome those, and we will be in touch. We hope you have a fantastic week, and we look forward to speaking with you soon.
Thanks.
Thank you.
Thanks.